So, hi everyone. I'm here with Craig Hinchliffe, who's the CEO of the Perch Group. They're a debt purchaser collections organisation. They've got in-house legal capabilities from a collections point of view. So, Craig, thanks very much. Thanks for joining me today.
Thanks, Chris. Yeah, glad to be with you. Glad to be back in the office as well today.
I wanted to ask you a little bit around the debt purchase market. I suppose what's happened a little bit in the debt purchase arena over the last 18 months. I mean, there's been huge changes elsewhere. It'd be good to hear sort of your perspective, really.
Yeah, and just before I go into that, I guess it's worth just framing where we are in the market. So we're not in the big tiers. We're not a Cabot or an Arrow. We sit in the lower to mid market. So some of the clients we deal with are more in the alternative finance space. So I'm going to be talking more about what I'm seeing in our space as opposed to in the tier one banking space. So I guess 18 months. Crikey, what an 18 months it's been as well. So I guess initially when COVID first started to bite, what we saw as a business and what we saw sellers do as well was basically kind of pull the shutters down. So as a debt purchaser, April, May, June 20, we basically stopped buying. And actually, to be fair, most of our clients stopped selling as well around the same point. So reasons for that, we were scared as to what was going to happen, both from a wider macro perspective, but also from a personal perspective, we were worried about the virus. So at the time, it was all about cash preservation, and just to see, understand the government initiatives and see where the world was going. I think from a seller perspective, they had their own battles to deal with. The sellers stopped originating, or most of the sellers we deal with stopped originating. There was a whole bunch of government initiatives coming around forbearance and all the changes they need to make to their account. So again, it was easier for them to stop selling. And then what happened? So around kind of late summertime, so August, September, we saw a couple of the clients come back online. We came back online as well. The furlough schemes were up and running. And actually, we from a collection perspective, we saw collections dip April, May, June, and then start to recover in July, August, September, which has been widely reported now. There's the haves and the haves not, and those customers that have definitely managed to save more and pay down their debt facilities. So it's been a really good time for the majority of debt collection businesses and debt purchasers from a collection perspective. Coming back to the purchase side of things, the market started to open up again kind of late 2020, albeit the volumes weren't there like they were what we saw. And the reason for that was, I guess, a lot of lenders really tightened up their scorecard, really thought about who they were lending to. There was a period, 3-4 months, where they stopped lending. So those charged, the typical flows just reduced significantly. And I think there's still a gap in the market. I don't think the lenders are fully back in, or they are now, but I think that hiatus lasted probably a good 12 months across the market. So there's been a slowdown in the debt sale market. Fast forward into 2021. Again, we had another lockdown at the start of this year. Personally, I found that the hardest lockdown. The depth of winter, another lockdown, we didn't know when it was going to end. From a debt purchase perspective, I guess the markets were open, but I guess everybody else was feeling pretty similar. So there wasn't a lot of activity in that Q1 of this year. Q2 has been a good year, and I think from what I'm seeing, the final quarter of this year is pretty hectic. There are an awful lot of sales on the market right now, and I think they should have got away kind of over the last couple of months, but they've been delayed for various different reasons. So the market's getting quite hot again at the moment.
I mean, it kind of feels like the pressure was building up, and so like there wasn't a lot of activity, and it's built up almost like a head of pressure for now. And it feels like over the summer, particularly after the summer, it feels like just like everyone suddenly started, the world's come to life again a little bit.
Yeah, absolutely, the world's come to life. The charge-off pots have grown, so the sellers are in the market again, and what that is therefore doing is actually driving prices up, because a lot of the buyers, a lot of the debt purchasers haven't, necessarily bought the volumes that they would have liked to over the last 12-18 months. So they've got a backlog in their kind of purchase volumes. The sellers are now coming to market. The debt purchasers are hungry, and that's really going to drive the price and drive the margins down.
And in I suppose payment capability in your models, how much are you sort of thinking about or factoring in, I suppose, people's capacity to pay, and has their people's capacity to pay changed as a result of the pandemic? And you sort of about it sort of like being sort of segmented to a certain extent, and it's like some cases it might be, in some cases it might. I mean, how are you thinking about that?
Yeah,
Because that can have a big impact on pricing, right?
It's really tricky, and for a business of our size, we've been going for about 4 years, and 18 months of that has been in COVID. And if you think we had a serious dip at the start, then we've had an uptick. We've been trending quite nicely. We've got the end of universal credit. Oh, sorry, not the end of universal credit. We've rephrased that. We've got the reduction in universal credit. We're thinking about how that's going to impact our customers. We're writing out to them. I think it's this week, just to understand if they need to re-engage. So I think it's really, really difficult to actually price the market from a collection perspective. You've almost got to go back 18 months and look at curves from 18 months ago and prior to that to understand what a normal customer looks like pre-COVID, rather than trying to look at the performance over the last 18 months, because I think I know that collections have been inflated the last 18 months. So you've got to look back, but where do we think the world is going? Crikey, what a macro question that is. I think, you've got inflation, you've got the end of the furlough scheme. Is there 1 million people currently sat at home looking for a job? I very much doubt it. I'd love to dig behind that number and see how many already are employed. All you see in the press every day is, there's a lack of resource right across the market, and that can only really lead, in my opinion, to wage inflation.
Inflation is sort of rearing its head a little bit. It kind of concerns me a little bit. And from a debt purchaser point of view, or from a collections point of view, how should we think about inflation or prepare for it? Because inflation is one way of eroding asset value, as an example, which can, if you're in a job, it can be a great thing, but if you're not, then it's really not a great thing either.
I mean, one bizarre way to look at inflation is if everybody's getting a 5-10% pay rise over the next 2 to 3 years, appreciate the disposable income isn't necessarily going up at the same rate. But the debt is remaining static. The type of debts we buy are a static balance. We're not adding interest and fees. So actually, the real cost of the debt to the customer is arguably going down in a world in which you have inflation. So there is an argument there that says there should be an increased collection rate due to an inflation within the economy. However, the reality is some of the customers that fall into financial distress are not likely to be the ones with the 10-15% pay rise that are benefiting from wage inflation, unfortunately. So I think it's another very difficult area that we need to consider in the longer term. I think here and now, if you listen to the government mantra, we think that inflation is going to be short term, not necessarily long term. But again, until we solve the labour market and the resource in the labour market, I think inflation is going to run for another 12 months quite strongly.
Yeah, I mean, if you have inflation and you have a job, then you get the pay increase. But if you don't have a job, which is more like in collections, then everything else is going up as well, which puts you more stressed, right? Which might make it more difficult to collect. That was one thought. But then the other thought is, well, then what happens to balances? So from a collection strategy point of view, you probably want to collect as quick as possible, I would think. From a cash flow and time value, it's going to change the time value of money, I would have thought.
Yeah, I mean, it's funny, isn't it? I think you've been in the collection world for a while. Everybody always wants to collect the money as soon as they can, for the full amount, and that's the optimal, that's the optimal outcome from a financial perspective. But it's not necessarily the way the world has gone. We're a regulated business, and you've always got to balance that with the consumer needs. And again, I just think it's very difficult to predict the impact of Brexit, the removal of a huge slug of our labour force. And what does that mean for real salaries in the real economy? Are we going to see more higher levels of employment and therefore a greater ability for customers to repay their debts because there is more job availability, paying higher rates? We've got Labour at the moment talking about a £15 minimum wage. How far away is that? 20 years? Is that the target? What does that mean to collections? Well, if you have a minimum wage of £15 actually in 5 years' time, that's going to be hugely beneficial to collections. But it's a bit of a gamble to build a strategy on that.
Yeah. So it seems like at the moment we're in almost like a bit of a wait and see mood, listening to you at least anyway. So we're back in the market's sort of activating again, or it's sort of active. But we're in that sort of like everything's shuffling around, just deciding sort of like how are we going to land. Is that kind of fair?
Yeah, I think that's exactly right. And I think so in terms of how we're approaching this, we're looking at the data from 18 months ago and prior to that. So trying to normalize out the COVID effect. We're not overlaying necessarily for inflation and the wider macro effects here and now. What we are doing though is just trying to build in a bit bigger margin to price in that risk, because there's definitely a number of risk factors which you've articulated already through your questions, and I think it's too hard to scientifically here and now put a number on those. Hence, we're trying to put a bit of margin in our prices. The challenge there is, like I said before, the market's pretty hot. There's a lot of people with cheap money, and therefore, trying to push a higher return may lose you the deal.
Yeah, you just like you're managing one aspect of it, but you've also got supply and demand at the other side, which is sort of, and everything's sort of interacting. Yeah. To go into the other side of the equation on the P&L, I suppose you've got the cost side as well, and in terms of like cost to collect, etc. I mean, digital's been a big theme. Digital transformation is now currently a pretty hot theme for most of the people I talk to. Are you seeing any of that with some of the customers you'd interact with? I mean, and how do you sort of see that sort of expanding or sort of rolling out over the next sort of like six months or so?
So it's definitely an area of focus for us. So there's a number of parts there, I guess, to the question. So what are we? I guess if we say just how is our business structured? So we've got a payment portal, and about a third of our customers currently interact digitally with that kind of coming through our agents in the call center. So again, what would we like to happen going forward? We'd like a lot more self-service. We'd like customers to engage, whatever channel they choose. But from a business perspective, the digital channel's there 24/7. We've got a full audit trail. We can control that conversation in a much more structured way. So we'd like to grow the digital channel, and we're looking at a couple of options at the moment, including open banking and how we could integrate open banking. As you know, what do customers in the debt collection world think of open banking? What's the uptake rate going to be? We're going to trial it and learn for ourselves. We've heard anecdotally it's very low, but again, it's the channel offered to the customer, and if that's the channel they choose, then we'd like to provide that. Cost to collect really interesting for us at the moment. We've recently just upped all our salaries for our low level staff. We actually applied a 10% blanket pay rise to all our agents. When we saw quite high levels of attrition after that Q1 lockdown this year, so most of the staff have been sticky right up till April, and then May, June, there was quite large levels of attrition. Not necessarily staff jumping from one call center to another, but staff having a complete career change. So moving to a new city, going in to try new things, etc. And anecdotally, I've heard across the sector that it's been the same. It's not just our business that suffered there. It's right across the patch. People re-evaluating what they want from life.
Yeah.
So we've had a lot of people leave. We've had to hire them back in. And coming back to the resource point, there's a real lack of skilled resource in the market. So in order to attract that, we've had to pay higher prices to get them in and try and our competitors. So talking about a pay rise, we've given a 10% pay rise across about 60 staff in our business.
It does feel like the resourcing challenges have sort of accelerated over the summer. So do you think that's just because people took a step back when they're sort of working remotely, and they just want to do something different, or do you think it's like people don't want to go back to the office? Or I mean, there's lots of different variations I've kind of heard.
I think it's horses for courses. Everybody's got their own story. I think with a lot of people have been on pause for 18 months, and they've come off pause and realised that they've just missed 18 months of their life. Yeah. And people are looking for something new, something different, an adventure. And those adventures were just part of everyday life historically. And now we're trying to work out how to replenish and make our lives richer. And I think working from home for the best part of 18 months, can be difficult. You're missing the social interaction, and just simply changing jobs, gives you something exciting to look forward to.
Yeah. And you could look at it as like, well, people change jobs all the time, and we've just got like, debt sales have sort of bunched up, and they're sort of happening all at once. So have moves of people, right, as well. So I mean, but we wouldn't have noticed it necessarily if it was spread over 18 months, or maybe not quite so much. I don't know.
Yeah, I think though within our business, what we've noticed is we've always had attrition. We're in the kind of environment where you get quite high attrition. What's different is the reason for the leavers. So normally it's, I've gone to another call centre and I'm getting paid £1 an hour more, and we kind of accept that. What we've had a lot of more recently is I'm moving to a new city. I'm starting a course. I'm going to university, and it's that whole kind of 2 feet into a whole new challenge, as opposed to a small incremental change.
Yeah, and it just gives you. We've all sat back and sort of reevaluated what's important, maybe a little bit.
Yeah.
So the digital piece you sort of see as much as sort of taking cost out, but also around sort of augmenting the experience from a customer point of view. Is that's kind of your approach? You talk a bit about open banking there.
Yeah, I mean, really, everybody's trying to do this, I guess, in the sector. It's easier said than done. You really do want to offer that omni-channel experience to the customers. You want to offer the easiest and best solution for that customer to interact. And for me personally, most of the things I do these days is via some kind of web portal or interface. It's available 24/7. It's less invasive. So a lot of our customers do work. Having a phone call can be quite difficult when they're at work, whereas if they can have a WhatsApp chat or do something on a portal, it can be much more discreet in the office environment. I think technology allows us to do that. I think a lot of people in the sector have a core CRM, and it's all about how you can API into that CRM and then build your workflows to engage your customers off that, in a not just a cost efficient, but in an integrated manner, so that you don't kind of go down one route with a customer, whether it's WhatsApp, but at the same time be accidentally lettering them or calling them. So it's making sure that the glue that holds your omni-channel together is holistic and is speaking. To prevent multiple comms to the same customer.
Sort of that integrated approach rather than just one channel or not. Sounds like that's sort of coming through.
Yeah.
So before we started here, we were just chatting about being back in the office. So you're in the office now. You see, I'm not. How are you finding it? How are you finding it being back? And how are your team finding it being back as well? I mean, benefits and pros and cons, I suppose.
Yeah. So from a personal perspective, we've got a lockdown dog, so we're now having to juggle a lockdown dog, and that's causing a few issues. I might actually try and bring it in tomorrow, so we'll see how that goes down. But what we found is the energy levels, the change agenda, all the exciting projects that we seem to have restarted since we're face to face, we're all put on pause whilst we're working from home. And what I think that is more to do with is the energy level. So this is our business, and I'm not saying it's true for every business, but when we are together in the office, we have a lot more energy. The staff feel more engaged. There's a lot more positivity around change, and it's the change agenda, I think, that's suffered in our business whilst we've been remote. I think actual productivity. It's arguable that I'm far more productive at home, and I think most of the staff are far more productive at home. So I think productivity is an interesting one, because there are a lot of distractions in the office. There is a lot of chat, a lot of coffees that I had throughout the day. So I don't think productivity comes into this as much as how we glue as a business, how we bring our culture together, and how we bring that change agenda together. That's the critical bit for me that we've struggled with, I think, during a lockdown environment.
It seems like there's a balance, isn't there, between sort of like productivity, and it's very transactional when you're doing video calls and you're just doing emails, versus almost like the softer human side of things, which is around almost like the social side of things, which is the human interaction, really, rather than social skills. It's human interaction skills. And how do you balance the two? And almost like we went from one to the other, haven't we? It seems like quite an extreme, and probably some sort of balance in between. How do you think it's going to be going forward?
Just picking up on something slightly different there, we've just rekindled our CSR committee. So we had a CSR committee pre-COVID, and for the last 18 months, we've not really done any major events other than the odd Zoom call with a quiz. Now we're back in the office, kind of like, where are we up to? So weekly football, weekly netball, gatherings on a Friday, Christmas party, summer party. So we've just literally put together the agenda for the next 12 months as to what our CSR roadmap looks like. So all of that has been on pause for the last 18 months, and you can't really underestimate kind of those softer touch points having a business and allowing you to integrate with your staff, have a stronger culture. So I'm excited to have the CSR back on the agenda, seeing people. I think to answer your question, how do I see this developing going forward? I think we're going to adopt a bit of a hybrid working pattern. New starters and more junior staff, we're encouraging them to be in the office. More senior staff who are kind of more back office focused, we've got less expectation for them to be in the office and happy for them to work from home. So we're going to embrace the hybrid working pattern and just adapt it as and when. But typically, 3-4 days in, 1-2 at home is where we're being a call center agent is a very hard job. Difficult. Customer circumstances are normally pretty difficult. Those agents have to deal with a lot of challenging calls. Actually, being in the office allows them some support around that to make sure that actually them as an individual are coping with their demanding role. We've seen quite a spike actually in the mental health of some of our call center agents over the last 18 months. It's a young workforce, 22, 23 average age. We've had to employ a counsellor, so we have a counsellor that comes in 2 days a week now and spends time with our staff trying to help them. And that's one of the challenges. I think COVID has taken a big toll on our younger workforce, and that the younger workforce is typically on the phones. And when they're at home, actually, I don't think that's the best environment for a call center staff member. Being in the office, there's a lot more banter, a lot more camaraderie. They seem a lot happier when they're in their office.
Yeah. So you're saying so doing the remote work is that you don't have those outlets such as your colleagues and best practice learnings, those kind of things. It can build up and sort of cause more sort of like stress and anxiety, which is then you're then finding sort of getting released when people then do go back to the office.
Yeah. I mean, a lot of the people in our call center are social individuals. They don't want to just get up and sit in a house, on a computer all day. Yeah. Their favorite part of the day is lunchtime, chatting with their friends. They're always having some kind of game going on, a quiz. There's always something going on in the office other than what they should be doing, which is speaking to the customers. But we accept that because it's a difficult job and you need to keep them engaged. You need to keep them motivated. And that's one of the challenges that we've had during lockdown, that they've not had that level of banter and enjoyment in their role.
Yeah. I think it's fascinating about the importance of social interaction in our in our work lives, and how that's coming through as a bit of a theme versus productivity, which has been a theme for the longest time, right? So it's important in terms of imagination and creativity and projects and all of those kind of things.
Yeah, 100%. And you'll know from Zoom, I think they've changed the settings now, but when you used to have 3 or 4 people on Zoom, it would zoom in on the person speaking. So the others weren't
huge.
Whereas the other people weren't necessarily. It was difficult for them to get their voice or opinion across.
Yeah.
Now, when you're in a room with 6 or 7 people, it's okay for 2 or 3 people to have a side conversation. Whereas Zoom only allows kind of one individual to talk at a time. And that, in some ways, I think has stifled a bit of creativity, a bit of challenge.
Well, it can be difficult when you're in a meeting, right? You can be taking notes and you're looking down, and people don't take offence. But when you're on a big screen, particularly in the big screen, people say, I'm looking over here at some notes I've got on my other screen. And it's like, I'm thinking, well, why aren't you looking at me, sort of thing? So it's quite an intense environment, isn't it? And I think we all had the Zoom fatigue quite a bit over the last, the last 18 months or so, because it's tiring, right?
100%. And then there's the whole, hiding your camera. So we're both showing our faces now because we're 100% committed to the conversation. Whereas the reality is when you've got the odd, the same management call every week, I'm guilty of this as well. You put your earphones in, you go on mute, and you go for a walk with the dog for half an hour, which is great from a work-life balance. But you're not at your desk. You haven't got the report in front of you, and it's if everybody's doing that, then actually, is that call as effective as it could have been? Probably not. And when you're in the office, there's no hiding. I think that's where you get the energy. When you're in the room, the energy is slightly higher.
Yeah. Now, I was chatting with someone over the weekend around time and the fact that our time has become sort of really quite efficient, I suppose, as a result of lockdown. But now we're having to almost like go back to maybe in the office working. And are you finding that time's getting more stretched? So, you know, you've got to commute, let's say, to work, and, you know, that could be an hour, 2 hours out of your day. It certainly was for me. I mean, is that putting stress, do you think, on employees in terms of like now having to fit even more in because they filled up the other free time they had?
Yeah, you know, and this isn't necessarily from speaking to work colleagues. This is more like my friends as well. We're all at breaking point with our social lives. You know, I've got 3 kids, and there's quite other family members with friends and with 3 kids. And every Sunday night, I have to sit down with my wife, and we have to plan a schedule out. It takes about an hour now on a Sunday night to work out who's doing the drop off, who's doing the pickup, who's doing, you know, dropping off, who, where, when. And again, I think this is another issue of pent up demand. So the kids haven't gone to a rugby club or football club or swimming or whatever it may be for 18 months. So you've signed up to all these clubs again. So you've got all this demand. You've got used to doing the school drop off, used to doing the school pickup. Don't know who used to do it before COVID, but we need to find that person and get them back. So there's definitely there's been a shift, I think, over the last 18 months as to what, you know, particularly for me, the level of interaction I've had with my children. I definitely have more interactions with them, and that's one of the COVID keeps. But you've got to balance that with, you know, being back in the office with a commute, and trying to balance everything else. So there's definitely far more demands, I think, on my time than there was pre-COVID.
Finally, I suppose I'll just get a bit of your take around what do you think is going to happen? What do you think is going to happen as we look forward to the market and then particularly to arrears levels as well, I suppose, and collectability?
Good question. So what's going to happen to the market? I think the credit card market is the most interesting market. I think that's going to be, I think lending levels will start to reduce in the credit market in the longer term with the uptick in buy now, pay later. I think buy now, pay later is going to be huge for the whole sector. But more people taking on buy now, pay later loans. I think when that becomes a regulated market, if and when it becomes a regulated market, you know, there's going to be a lot of customers with a lot of debt that will just pop up from nowhere. So there's going to be a new market in the buy now, pay later segment, I believe. The credit card industry, I think, will lose customer share to the buy now, pay laters. And I think the personal loan market will reduce slightly again because there'll be less people consolidating loans off the credit cards because they're not taking out they're not using the credit cards in the first instance. We know that people have a larger level of savings at the moment. We know we're in a really low interest rate environment, even though interest rates will start to increase. They're not going to increase massively. The Bank of England cannot afford for them to go up given the level of debt we're carrying. So I think we're going to be in a really low interest environment. So therefore, lending will remain cheap in the mortgage market. I think those with a good credit file can continue to access, really cheap rates for personal loan and cars. And again, you'll see there's huge demand in the second-hand car market. So there'll be good lending off the back of that. I think the challenge is kind of on the new car sales. Can they even get the cars? We're back into the supply issue. We're into this really strange of just because you want an extension or a new car, can you even get hold of one? So again, I think lending is going to be slightly curtailed for the next 12 to 24 months because of supply. You can't get the cars, you can't get the builders, you can't get the holidays. Even if you might want the holidays, think of the airlines. Have they got back to capacity? We know they're nowhere near capacity. Those big spend items that people would typically pay on credit, they're just, we're not there yet. I think we're another 12 months from the market being a bit more normalized. So I think lending levels will continue to be reduced. I think the buy now, pay later is going to eat into credit cards, which have a knock-on effect on personal loans. So I think there's going to be a slightly subdued market.
That's interesting. So although there might be demand for loans out there, the supply issues that we've got at the moment might be curtailing some of that in the short term. Yeah. Well, Craig, thanks very much for spending time with me. I really appreciate it. Some great insights that you've got in the market and really across the industry, really. So I appreciate you spending the time.
Thanks, Chris. Should I put my indemnity on the end of it? These are my opinions, not the opinions of Group or any other employee of the Perch Group.
You're quite welcome to. Yeah. Thanks very much.
Cheers.
Okay. Thanks.